All right, let's talk about MTAR Technologies. This is a company that's really made a name for itself, shifting from being just a niche parts supplier to a real powerhouse in India's precision engineering space. So in this explainer, we're going to dig into the latest equity research that has everyone buzzing. We'll look at the big turnaround, the bull case, and, of course, the risks. Ready? Let's dive in. Okay, so what's the big takeaway from this new report? Well, it's pretty straightforward. MTR's fundamentals are looking really strong. You know that whole precision engineering 2.0 strategy they've been talking about? It's not just some corporate buzzword on a PowerPoint slide anymore. The latest numbers prove it's working, and it's pushed the company into a whole new chapter. So here's the core idea, the big thesis. MTR has really changed the game. It's no longer just a simple component supplier. The whole perception is shifting. I mean, for years, people just thought of them as a company that made specific little parts. But now, the argument is they've become a genuine Tier-1 subsystem powerhouse. And you might be asking, so what? Why does that matter? Well, it matters a lot. It means they're not just shipping out individual parts. They're building and delivering entire complex systems. This is a huge deal because it means stickier client relationships, much better margins, and a way stronger position in the industry. And this right here, this chart really tells the story. For the longest time, MTAR's success was basically tied to the fortunes of just a couple of major clients. But look at this revenue mix now. Clean energy, we're talking fuel cells, hydropower, that whole space, now makes up a whopping 70% of their revenue. That kind of diversification, moving away from relying on just one or two big customers, is probably the clearest proof you can get that their new strategy isn't just working, it's thriving. So the big question is, how did they actually do it? This kind of turnaround doesn't just happen by accident, right? It was all built on a very deliberate strategy, really resting on three key pillars. Let's break those down. First up, and this was probably the most crucial piece of the puzzle, they had to deal with their client concentration risk. I mean, for a long time, they were heavily dependent on Bloom Energy. So as you can see here, they made a strategic push to diversify. And they didn't just get small contracts. They've secured long-term deals, integrating themselves into the supply chains of global aerospace giants. We're talking about names like Thales, GKN, and Collins Aerospace. That's a huge shift.
All right, the second pillar was all about moving up the value chain. Think about it this way. Instead of just making one cog in the machine, they started building the entire machine. They shifted from single parts to complete complex systems. We're talking about things like critical components for the SSLV, the small satellite launch vehicle, and even entire green hydrogen electrolyzers. This is just a much more valuable way to do business. And the smart part is they're using their existing engineering know-how, so it's not like they had to spend a ton of cash to build these new capabilities from zero.
And here you go. This chart basically sums up the payoff. After a really tough patch back in early 2025, you can see margins dipped below 15%. They've had this incredible recovery. EBITDA margins have shot all the way back up to 23% in the most recent quarter. What this really tells us is that the hardest part, the really expensive, capital-heavy part of this turnaround, it's probably in the rearview mirror.
Okay, so that's the story of the turnaround. Now that the foundation is solid, let's switch gears and look ahead. It's time to build the bull case. What are the big arguments for why this growth is just getting started?
The number one thing that jumps out is the company's operating leverage. And you could really see it in action in the Q3 FY26 numbers. Their profit after tax, or PAT, shot up by a massive 117% year-on-year, coming in at 34.7 crores. And get this, that was driven by their highest ever quarterly revenue of 278 crores. So the key takeaway is simple. As their sales go up, their profits are going up way faster. That's operating leverage in a nutshell. Now, this is where things get really interesting. The revenue visibility. The company isn't just sitting around hoping for new business to come in. They have a locked-in pipeline. Their order book is at a record high, almost 2,400 crores, and management thinks they can get that up to 2,800 crores by the end of the fiscal year. For an investor, that is huge. It gives you a strong, predictable stream of revenue for years to come, and that takes a lot of the guesswork out of the equation.
On top of everything MTR is doing right internally, they're also perfectly positioned to ride two massive waves in the broader market. First, in defense and space, they're set to be a major beneficiary of a potential 25% increase in defense spending. And then you have nuclear power, where India has this huge plan for a 10-fleet reactor build-out. A big part of that plan is making critical parts locally And guess who's at the front of the line for that? Yep, MTR.
Okay, but no analysis is complete without looking at the other side of the coin, right? The bull case is strong for sure, but the research also points out some pretty significant risks we need to talk about. So let's dig into the bear case. So the biggest red flag here is the working capital cycle. As you can see, it's sitting at 266 days. That's high. So what does that actually mean? Well, think of it like this. For almost 9 months, the company's cash is stuck. It's either tied up in raw materials sitting in a warehouse, or it's waiting for customers to pay their bills. When you have a cycle that long, it can really squeeze your cash flow. It might even force the company to borrow more money just to keep the lights on and fund growth. And taking on more debt always comes with its own baggage. And it's not just about the cash flow. There are a few other big risks to keep an eye on. First, valuation. The stock's price-to-earnings ratio is, let's just say it's rich. The report puts it somewhere between 60 and 140 times earnings. When a stock is priced that high, the market is basically expecting perfection for years into the future. There's absolutely zero room for error. Any tiny slip-up, any project delay, and the stock could take a major hit. And that risk is even bigger because the stock has a high beta of 1.35, which just means it tends to be more volatile than the market as a whole. And finally, you've still got some dependency risk, especially on government timelines for those big nuclear projects, which, let's be honest, are famous for delays. So we've laid it all out, the impressive turnaround, the really compelling bull case, and the very real risks. How does the report tie all this together? What's the final take? The report's final verdict is pretty clear. It says you shouldn't think of MTR as just a short-term cyclical bet anymore. The argument is that it has become what they call a structural compounder. That's a fancy way of saying it's a company that's set up for long-term sustainable growth. The main point is this. The hard part, that whole turnaround phase, is over. Now, the company is officially in the execution phase, which is where the real work begins. And that really leads us to the one critical question that hangs over everything. The story is fantastic, right? And the turnaround they've pulled off is undeniable. But with the stock priced for absolute perfection, can the company's execution actually meet the market's sky-high expectations? That is the #1 challenge facing MTR and its investors from here on out.